Welcome to What the F Just Happened with Eric Dubin and Dave Kranzler, and this is our second show. We've got a lot of action going on in the markets, Dave, and it's really interesting to see silver getting really clocked after what we saw last week spike up on Wednesday. Our first show, we talked about how the net short position was very extreme when it came to the large speculators on the cotton numbers, and we expected it to, it was signaling that sentiment was really, really despondent when it came to the large specs. And we saw last week a shift in the numbers where the large specs increased their long positions in the COMEX bit by 1,576 contracts, and they decreased their shorts by 13,170. And a lot of people in the precious metals space looked at that and got really excited because typically the large specs are the bag holders when it comes to the bullion banks and the forces that manipulate the COMEX paper market. They actually were on the right side. Hedge funds were positioned to benefit from the jump up that we saw in silver on Wednesday when we got over 17. We saw momentum fade on Thursday and Friday, and that typically is a telltale sign that the cartel forces that like to keep a lid on silver are in fact trying to quell upwards momentum and keep hedge fund speculators thinking that there's no momentum to chase, because the hedge funds tend to be momentum chasers. And lo and behold, we're recording today, April 23rd. Silver was whacked for greater than 50 cents down. What's your take on what's going on?
I never got that excited about the structure of the commitment of traders with silver futures. And the reason is the banks, a lot of people were looking at just the swap dealer category, or they might just look at the overall commercial category. And you got to go into the report itself and look at the detail, which you got to go into the disaggregated reports. And there's also a category called producer, merchant, processor, and they still have a very large net short position. And, I mean, it's impossible to prove, but I suspect that the banks throw a lot of their positions into that category as well. I mean, J.P. Morgan's already been tagged by the CFTC for throwing its house trades into the other reportables category in silver, and they were fined a whopping $650K or something. You know, the cost of doing business for them. It certainly wasn't enough to discourage them from cooking the books in terms of how they allocate their house trades between the swap dealer category and the producer, merchant, processor. And in fact, they could actually say, well, we're a merchant of silver by virtue of all the other activities that we do, like OTC derivatives, so we got to keep that side of our business hedged, and so that would get thrown into the producer, merchant, processor, user category. So at any rate, while the overall structure of the silver positioning on the commitment of traders might have looked bullish, and it certainly did, especially given the fact that the hedge funds were net short, you got to also look at what's going on in gold, because gold and silver trade in tandem. They're highly correlated, and typically before a big move starts higher, gold starts off the move, and then eventually silver takes over and outperforms gold. Well, we haven't seen that move yet, and the commitment of traders, the way the traders are positioned for gold is still bearish to very bearish, and by that I mean the banks have a large net short position in gold contracts, and the hedge funds have a large net long position in gold contracts. And I actually wrote a blog post about this, probably 2 weeks ago, where I said, essentially, don't get that excited by just looking at silver. You got to look at gold also. And to the extent that they can keep the price of gold capped, they're going to keep a lid on the price of silver. Now, silver had a nice pop last week because silver is obviously a lot more volatile than gold. It has a higher beta. And on days when gold goes up, silver is going to go up more percentage-wise. And I think we probably did see some short covering. Was it Wednesday last week where we had the big pop in silver?
Yeah.
Yeah, I think we saw some short covering going on. But we don't know what that would look like because the commitment of traders report cuts off on Tuesday. So, a lot of times all the action in the market happens after Tuesday because then you don't get to see what happened after Tuesday until a week from Friday.
Right.
For me, when I look at gold, it's trading essentially between 1320 and 1360, and maybe on the outside 1310 and 1360. They've got it capped at 1360 right now, and I don't know how much longer they're going to be able to keep it capped there. But I think at some point before the end of the summer, we're going to see it plow well above 1360. The bad news is the cap on the upside right now. The good news is they've tried for quite some time now to get gold below 1300, and they've failed on every attempt. So I think what it's going to take for this whole thing to turn around is for something to trigger a liquidation of the hedge fund net long position in gold. And also, that'll also take the open interest down on the COMEX by 70 or 80,000 contracts, which is usually when it's in the last couple of years when the open interest has been down closer toward 400,000 rather than at 500,000 where it is now. That's usually where rallies have started in the sector. I mean, large, meaningful rallies.
We discussed this actually in our first show and how it's going to take some movement within the gold pit. There's a lot of talk now about the dollar seeing a very excessive short position and zero hedge is trumpeting that, and people are a little concerned about that, and the context as well of very large issuance of bonds coming this week on the Treasury calendar. Do you believe that we're seeing another example of the dollar being supported in an effort to make the bond auctions go well later this week?
Well, that's a good question. I mean, there's a lot of things going on with the dollar right now. I mean, it closed, the dollar cash settlement contract closed above its 50-day moving average on Friday. So, I mean, who knows what today is all about with the dollar. It could just be some technical buying going on because it's now above its 50-day moving average. If you look at a chart of the dollar, it's been kind of trading between 91 and 88 roughly, plus or minus at the top end and the low end since early January. So it's been going sideways. Obviously, zero hedges presented the story that there's a large short interest in the dollar index contract. I mean, to me, that's a pretty small contract in the context of global FX trading and global dollar trading. And to me, there's just, as we were discussing earlier, Eric, the supply of dollars out there. I mean, there's just literally oceans of dollars floating around out there. And I don't see how you can engineer a short squeeze other than maybe technical short squeezes when you've got plenty of the underlying that you can go out and get to deliver. So, I mean, in terms of whether or not they're pushing the dollar, they could be pushing the dollar a little bit higher this week. I mean, there's almost $100 billion in 2s, 5s, and 7s treasuries being auctioned off this week, and that's a big chunk of treasuries for investors to buy. And we know we're not going to get a lot of help from traditional treasury buyers. China might be in there, they might not be. Japan's been reducing their treasury stock slightly over the last few months, and obviously Russia's been selling. They're a large holder. So I think it's going to take higher yields to clear the auction this week, and they could be pushing the dollar up. The Fed may be pushing the dollar up to try and support the auction process this week.
Yeah, and we are testing 3% on the 10-year right now, and that trend has been in place for a while.
Yes, and that could also, the spike up in the dollar today could be connected to the fact that, interest rates are higher today. I mean, there's also shorter term correlations between the dollar and rising interest rates, or, falling interest rates and the dollar going lower. So I think it's a little more complicated than, we're seeing a short squeeze in the dollar, because if you look at a chart of the dollar, I mean, it really hasn't moved that much.
Yeah. Well, we're still in a period of biding time, and we'll see what it is that brings more interest to the gold market. But the most important takeaway that we can see is that gold has had some very strong support. In our first show, we discussed how it's not likely that we're going to see any kind of sustained move below 1,300. And meanwhile, there are speculative interests floating around that come to silver, as we saw last week, but it's not a sustainable kind of market move because of the suppression that we see. And Thursday and Friday of last week, as I discussed with Jason in our show yesterday, it telegraphs how we see complete reversals when the commercials and bullion banks come in and squash any kind of move into precious metals, and that's what today is all about. So when we look forward into the months ahead and into the summer, it's not clear exactly what kind of catalysts, or if any in particular, will come that'll represent a shift in the way people trade gold in the COMEX, and the paper tail is always wagging the physical dog when it comes to the price-setting mechanisms in the COMEX and in the LBMA. So what's your outlook when it comes to gold and silver in the months ahead, Dave?
It's a good question. I mean, there's so much global central bank intervention in the precious metals and in the currency markets, you know, in all the markets actually. It's kind of sterilized the ability to, you know, read the tea leaves and figure out what's going to happen next. But I put a chart that in my last issue of the Mining Stock Journal that was out last Thursday, and it's essentially a 5-year. Well, actually, it's a chart of GLD, you know, representative of gold from 2010 to present. And when you look on the chart, you can see a very, very powerful 5-year basis formed. I mean, it looks like it's kind of got the chart of gold looks like a bowl, and if you put that next to the U.S. dollar, you can see it's essentially formed the opposite. The U.S. dollar looks like an upside down bowl, and so, you know, again, regardless of which way the dollar goes in the short term, I think the dollar is going to go a lot lower. And I also think that when gold breaks out of this 5-year base that it's formed, you're going to see it could easily spike up $500 to $1,000 in a very short time period. And again, I don't know when that's going to happen. I just know that intervention does not work forever. And, you know, we're seeing the reason why they're having trouble getting gold below 1,300 is every time gold gets taken down to the low 1,300s, India and China come in and start buying again. We saw that in the numbers last night, in the overnight numbers on the data that I get a hold of that comes from India and the data from the Shanghai Gold Exchange. So I just think that probably the most definitive thing that I can say right now is that gold should be quite a bit higher at the end of the year than it is right now.
The most likely catalyst is going to be, you know, rising interest rates pressurizing the stock market, and the very significant correlation where equities go down and people are looking for safe haven assets, and gold usually benefits. So we shall see. But we've seen significant support. We've seen higher lows, and gold has been in a stealth bull basing market, and the underlying strength coming from physical buyers in Asia is supporting the market.
Yes, and it's funny because, you know, one of the common narratives out there is that gold's having trouble moving higher because interest rates are going higher, and that statistical studies that go back to 1971 show, in fact, just the opposite is the case, that more than half the time gold has its best periods of performance when the Fed is hiking interest rates. And in fact, it has its best, by far its best performance when the interest rate hikes are gradual as opposed to a sudden yank up in interest rates the way Volcker did in 1980. So, you know, contrary to the common person narrative out there, gold's not having trouble getting out of its own way because interest rates are rising. It's having trouble getting out of its own way because of the massive intervention that's going on in the paper gold market on the COMEX and the LBMA.
Well, thanks again for listening to our second show of What the F Just Happened. And we'll be doing this on a weekly basis. Anytime there are big moves in the markets or anything of particular note, we'll spotlight it and discuss and put it into context. If you'd like to follow Dave Kranzler's work, you can find it at investmentresearchdynamics.com. You can follow my work at facebook.com/Eric Dubin. The show is kindly brought to you by Wall Street for Main Street. Please subscribe to Jason Brock's Wall Street for Main Street channel, and we'll come to you next week. Thanks for listening.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship, and hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.